Hey everybody, this is Colin Murphy and Torcana podcast number 27. It's been a long time since I've done one. I'm delighted to be back. For some reason in the last few weeks, I've had people reminding me about my podcast they've been digging them out and listening to them. So here I am back in the podcast desk recording another one, and I'll try and get a few more done this side of Christmas as well. So today's theme is an important one to me. It's how to balance capital growth versus cash flow. Okay, it might sound pretty obvious, but I'm going to dig into it a little bit and hopefully give you a few insights. So, look, ideally we all want to have it all, right? You want that property that's in a great location that you get for a great price and it rents out like a dream and provides a high return. We all want that. It all sounds great. And some people actually did get those kinds of properties during a very short window, maybe in 2011, okay? But look, the reality is different and there's pros and cons to every deal. I look at, 30 or 40 deals a week. There's pros and cons to them all. So buying in the best locations isn't all roses. It's not all good. And buying in the hood isn't all bad either. I mean, it depends on your attitude to risk. It depends on what research you've been doing. It depends on what your expected outcome is and where you live. So, I've been buying and renovating and selling properties for a while. Generally do more than 100 deals a year. And I always try and find those Goldilocks deals for rentals. So I'm referring to rental properties that are affordable, that generate a solid rental return, but they're still located in neighborhoods that are high enough quality to appeal to both owner occupiers and quality tenants. So I'm kind of hedging my bets a little bit. I don't want a property that's too expensive. I don't want one that's too cheap. I want to make sure I can get out if I need to. I want to make sure that I'm generating a solid rental return. That's all good, and that's what I've been doing. But one issue I haven't really spoken about enough in the various podcasts and seminars and webinars I've done over the years is just how much capital growth can drive your overall return, how much difference that actually makes. So I'm as guilty as anybody about this, but I often feel that sellers, people that are selling properties to investors, they push the benefits of the year one cash flow too much and don't spend enough time talking about what actually makes you money over time. Okay, so let's say you're kind of considering four or five different markets. You might just have your spreadsheets and you're looking at basically the year one cash flow for each one, gross income, purchase price, expenses, mortgage payments, etc. And you're trying to compare like with like. But you should really be looking at a 5 to 10 year pro forma. You should really be looking at the effects of mortgage pay down and equity growth, and you should be comparing those numbers. They're all fundamental things to be aware of when you buy, but don't expect them to get handed to you on sellers on a plate, and don't expect them to make it easy for you to compare one market with another. That's not really their job. That's the buyer's job. So the reason I'm saying do a 5 to 10 year outlook and look at mortgage paying out and equity growth is because what if you have 10% year one cash flow, let's say in a market like Chicago, and then you've 7% in a market like Tampa? I mean, 10% sounds way better than 7%. Getting 30% over 3 years sounds better than getting 21% over 3 years. But look, what's going to happen to your investment if one of those markets is appreciating by 1 or 2% and the other one by 7 or 8%? Big difference. In a market like Florida, which has 7 or 8% capital growth, the extra equity earned can be the equivalent to an entire year's gross rental income. A lot of my properties are earning $1,100 a month. Okay, so say $13,000 a year. The appreciation on those properties is often more than 13,000 a year. It's like getting double my rental income. My net worth is doubling. You've your net worth from your equity and you've your net worth from your cash flow. And there's net worth from other things as well, which I'll talk about. But look, I'll be the first to admit nobody can predict where property prices are going to be in 2 or 3 or 5 years' time. But you can't really predict where cash flow is going to be in 2 or 3 or 5 years' time either. I mean, you can prepare for it, you can balance it, you can make sure you're getting a property that's got capex items taken care of, but you can't really predict it. What I can say is that Florida, for sure, is one of those rare markets that's been delivering both solid growth and solid rental returns. The cash flow might not be as high as some of the Midwest or the Rust Belt cities, but the market has certainly appreciated a lot faster. and it shows no signs of slowing down. Okay, so I mean, I've owned rental properties, for quite a few years, and I can tell you that the net rental income from each one doesn't make much difference to my personal life. I mean, I earn my income in one way, and I monitor my net worth in a different way. So if you have a property, whether it's $100,000 property or $200,000 property, once you have it leveraged by 80% and you're paying taxes and property managers and insurance and everything else, maybe you're getting 100 a month, maybe you're getting 150 a month. I'd be surprised if you're getting much more than $3,000 a year. So it doesn't make a massive difference to your net worth or your free cash flow. But what does make a massive difference to your net worth is how the equity in those homes increases over time. Okay, so for me, from my point of view, as long as a property is cash flow positive, after paying mortgages and so on, it's much more beneficial in the long run to have a rental income in an appreciating market than a rental income in a stagnant market. Okay, it makes sense, right? There's a big but here. So the trick is that you have to choose markets where the appreciation is supported by fundamentals and not by speculation. Okay, let me give you an obvious insight here. You can avoid a lot of curveballs just by buying in cities and states with high population growth and high job growth. That's where your equity becomes stable and self-sustaining. That's where your loan pay down becomes a lot smoother. Why? Because high population growth will naturally lower vacancies and increase rents. Okay, if the population is increasing a lot of fast, you've more demand for rental properties. You've more demand, that'll drive up rents. If more people are coming, it's more difficult for them to move to another house, so that's going to lower your vacancies. Also, high population growth is obviously going to increase demand for those houses, which in turn is going to increase the value and the price of those houses. So, high population growth is good for your lowering your vacancies, increasing your rental income, and increasing the value of your house. And I think we could all do with a little bit of that rising tide, right? So what I love about Tampa, for example, is that the population grew by 28% since the year 2000, and that unemployment is 3.6%. Okay, they're two good numbers. An even better number is that homes in Tampa are 27% lower than the US average. You're just ticking all the boxes. I mean, number one, the population is growing very fast, which has the benefits I just outlined. Number two, job growth is very high, which is also a benefit. And number three, house prices are way lower than US average. That just is a sustaining circle where more and more people are going to come here for the jobs, the quality of life, and the affordability. So really, whether you're investing for the short, the medium, or the long term, you should look at trends that are going to affect house prices, not just your initial cash flow. That's you're only looking through a keyhole if you're looking at the cash flow. You need to look at trends that are going to affect house prices. Now, obviously, there's always going to be market corrections. There's always going to be bumps in the road, but don't let that stop you from investing in the right direction. Don't let that invest you from going where the fundamentals are pointing. So, for example, real estate investors, get paid 5 different ways from rental properties, and the cash flow is just one of them. Okay, you get paid 5 different ways from properties. Cash flow is just one. What are the other 4? You get paid from appreciation. If your property appreciates from 100,000 to 112,000 a year, that's 12,000 for you. That's you getting paid 12,000. Your cash flow is the second one. Okay, we all know about the cash flow. Your loan pay down. Okay, tenants paying down your loan. You're getting paid by that as well. That's your, as a percentage, if your loan's maybe $1,200, maybe 400 of that is capital and 800 of that is interest. They're paying that capital down for you every month. Okay, they're paying it for you. You've tax benefits as well. You can deduct your mortgage interest. You can depreciate your property. You don't even pay tax on all your rental income. I mean, it's hard to measure that, but that could easily be another 3 or 4% a year. You're also getting paid by an inflation head. That a lot of even advanced investors don't consider that. So just like inflation can erode the value of savings sitting in a bank doing nothing, it also erodes your mortgage debt. Okay, you've got a mortgage at a fixed interest rate. Okay, it's got that drag diluted over time. It's easier to pay back when inflation is there because inflation increases your rents, increases your property value, but your mortgage stays the same. So that could easily be another 3 or 4% a year. And people are talking about inflation coming, people are talking about interest rates rising. So there's a lot of things going on. So cash flow is just one of 5 ways you're getting paid by property. So you need to look at the others as well. And to remind you, the other 4 are appreciation, loan pay down, tax benefits, and inflation hedges. Okay. So I'm going to dig into these issues a little bit more in another podcast. I've also got some exciting new trends that I want to dig into that I think all investors need to be aware of before they make their next investment. So, stay tuned for that. I'll be doing more podcasts. I think I just wanted to give you a nice short, 12-minute. Here I am again, and I'm looking forward to doing more. So there you go. Bear that in mind. When next time you're looking at your real estate investments, or even if you want to analyze your current portfolios, just have a look at how it's balanced between capital growth and cash flow. I mean, some people get down in the dumps because they broke even, or maybe even they lost a little bit of money in their rental property. I mean, that's obviously no fun, but look at those other 4 sources of income as well. Maybe you earn more money than you thought. Okay. So, happy investing. Great to be back doing podcasts again. Your feedback's always welcome, especially new ideas for other podcasts you want. So, but for today, this is me, Colin Murphy, signing out. Have a great day. This recording contains general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax, and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. While we have no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Opinions of the host are not necessarily shared by other employees and partners of Torcana and its subsidiaries.